You're listening to the WBT Podcast with Michael Lodge. Listen to all of our podcasts at www.wbtpod.com. Stay informed. Let's get started.
This is brought to you by Lodge & Co., a business and tax advisory firm where your success is our goal. Call us today toll-free at 888-681-1518 or visit us at www.lodge-co.com and learn more about what we can do for you. Lodge & Co., your source for sound business and tax services.
And welcome to the WBT. This is Michael Lodge. I'm glad that you've joined me this morning. I have luck today because it's raining cats and dogs out, so I don't have to go outside and work on the property today. Yesterday when I got done, I was literally covered from head to toe with this red clay that gets all over you. And when you try to wash it out, it's really hard to get it washed out, even out of your hands. My hands are still a little bit red, a little bit of orange in it. So, I'm lucky today, so I get a break and I get to stay inside my house and into my home office. I should probably go down to the into the Greenville office and work a little bit, but I just don't feel like it today. I tell you, my body's still recovering from construction work on this house, so I think today, on this Friday, since my office is really supposed to be closed on Fridays, I'm going to pretend I'm closed also. But I wanted to go over just a little bit about the new tax laws and how it affects small business. We had a sweeping tax overhaul change. Probably the most sweeping tax overhaul in 3 decades. And it brings a lot of good news for businesses ranging from a lower corporate tax rate to big tax savings for asset purchases. But there are also some deductions that disappear and other breaks that are, kind of taken back or pared back, if you want to use the correct tax term. And what happens is that offsets part of the massive costs of the tax cuts. So let's take just a little bit of look at what's going on with the new tax law and how it affects businesses, okay? And the first one is that the new tax law reduces the income tax rate on regular corporations. And we know those as C Corps, okay? So C corporations, from a top rate that used to be at 35%, and it's now down to a flat 21%. Personal service corporations also get the 21% rate, although the low rate is a boon for most corporations. Small C corporations could actually end up paying just a bit more. That's because the law didn't keep the 15% corporate rate on the first $50,000 of taxable income. For example, if a C corporation had a $30,000 of taxable income, they'll pay $6,300 on taxes when it files its 2018 federal tax return, compared to $4,500 under prior tax law. So there is a little bit of issue there for the smaller corporations that are making less money. So one of the good things is that there is a tax relief for pass-through businesses. Pass-through business would be like a S corporation or an LLC. So while cutting the corporate rate to 21%, the lawmakers decided to offer a different kind of relief to sole proprietorships and farmers who report their income on a Schedule C. Schedule C is on your personal income tax return as business or profession income, or on an F, which is a farm return on your personal income tax return if you own a farm, and to individuals who pass through entities such as a S corporation, partnerships, and LLCs, which pass their income to their owners or members for tax purposes. So starting with the 2018 tax return, many of these people can deduct 20% of their qualifying income before figuring their tax bill. This change is one of the most complex provisions of the new tax law. Now, you remember they were supposed to simplify everything, but they really did kind of complicate it just a little bit. That's because there are lots of special anti-abuse rules and restrictions, most of which apply to high earners. These are also, there are also lots of unsettled issues and as yet unanswered questions that are begging the IRS for guidance. Once the tax laws get passed, then they have to go to the Internal Revenue Service and they have to interpret it, and then they have to put it into the code and they have to make it understandable to us, which very seldom happens. So, two rules to taxpayers. With taxable incomes in excess of $157,500 on an individual return and $315,000 on a joint return. First, the break phases out for those people who are in many professional service fields. And if you're in an affected field and your taxable income exceeds $415,000 for joint returns and $207,500 for all others, the deduction is zero for that business. Second, there is a W-2 wages paid limitation for high income earners that apply even if the person isn't engaged in a specified service business. This caps the deductions at the basic 20%, or if lower, a figure that looks at W-2 wages paid by the firm in the basis of certain assets. So you have to think about that and really talk to your accountant on that, because it's very important that you understand that. Also for businesses on the buying of assets. So 100% bonus depreciation is back. Firms can write off, or companies can write off the entire cost of qualifying assets that they buy and place in service. After September 27, 2017, okay, it generally lasts until 2022 and then phases out 20% for each year thereafter. Okay, so it changes in years. And remember, this tax overhaul is not permanent. It changes out there in several years. So don't think that this is a permanent situation, because the Congress has to come back and vote on it again. And whoever's in power, if it's a Democratic-led legislature, don't ever expect to see it come back. In fact, Nancy Pelosi is out there right now saying they want to raise the taxes. So just remember that this tax overhaul is not a permanent situation. Okay? So let's get back to the property and the buying of the assets. So more property is eligible for expensing. So you can expense a lot of this stuff out. Included now are depreciable personal assets such as predominantly to furnish lodging, such as beds, refrigerators, and stoves in hotels, apartments, or in dormitories. Also eligible for certain improvements made to commercial buildings like roofs, air conditioning systems, fire protection and alarms, and also security systems. New farm equipment can be depreciated over 5 years instead of 7 years. This doesn't cover grain bins or cotton ginning assets, fences, or land improvements. Note that the law keeps the current depreciable recovery periods for real estate, 27.5 years for residential rental property, and 39 years for commercial real estate, okay? The bigger vehicle tax breaks, now is the best time, tax-wise, to buy a vehicle. Might not be economically wise, but tax-wise, to buy a vehicle for your business. That's because buyers of new or used business vehicles get lots of breaks under the new tax law. The annual depreciation caps for passenger autos it rose sharply. If bonus depreciation is claimed, the first year ceiling is $18,000 for cars acquired after September 27, 2017, and put into service in 2018. So the second and third year caps are $16,000 and $9,600. After that, $5,760. For autos bought before September 28, 2017, but first placed in service during 2018, the first year cap with a bonus depreciation is $16,400. If no bonus depreciation is taken, the first year ceiling drops to $10,000. The breaks, and even juicier for buyers of heavy SUVs or heavy pickup trucks, thanks to the bonus depreciation. If you purchase a heavy SUV for your business, you can write off up to 100% of the cost. And if you buy a heavy pickup truck for business use, you can expense up to the full cost. So right now would be a good time to put a truck or some type of automobile into service, because you have better tax breaks. Because you remember, as I told you before, all of these things do not last, okay? They will come off at some point in time, okay? So one of the things that got wrote off, axed, like for golf club outings, client meals, that's still in limbo, okay? We're not quite sure what the IRS is going to say on that. We're still waiting. Before 2018, firms could generally take a tax write-off for half of their business-related entertainment costs. So the tax law eliminated this break. So no more writing off show tickets, golf course fees, sporting events, and stuff like that. Okay, so it's just not going to. It's not there anymore. Even if you're taking your clients to these things, they're gone. Holiday parties are still fully deductible, and no changes to employees' meals while on business travel. Still 50% deductible by the employer or the business owner. The cost of an employer-operated eating facility, such as a cafeteria, which used to be fully deductible, is now subject to a 50% bite. After 2025, the cost is completely disallowed. As I said before, this is not a full-time tax bill that was passed. It ends at some point in time. The deductibility of client meals is kind of murky at the moment. There's a sharp divide among tax practitioners on this issue. Some tax professionals say that client meals, such as at a restaurant for a business dinner or post-golf lunch at a country club, are 50% deductible if business is conducted or discussed. Others aren't so sure. I mean, we'll kind of have this up in limbo. They're not so sure and take the position that client meals can't be written off anymore. This issue is obviously begging for the IRS guidance sooner rather than later, because we're almost halfway through the year and we need to be able to tell our clients, is it or isn't it? To be on the safe side, though, businesses or business owners should track all of their receipts in separate ledger accounts based on the specific type of meal or entertainment expense. Remember what I've told you before is that you need to document. It's vital. So we also have to say goodbye to one other thing, and that's to domestic production deduction. Domestic production deduction. Say that 3 times. So the new tax law brought an end to the popular write-off for 9% of income derived from U.S. production activities. Business, lobbying groups, and tax professionals who are hoping for a 2 or 3 year phase-out period did not get their wishes. This happens sometimes when you're dealing with senators and lobbying groups and everybody else. So repeal is effective for tax years beginning after 2017. This means taxpayers with a fiscal year ending that straddles 2017 and 18 may still be eligible for the deduction. So let's also talk about the squeezing out of commuter benefits. The new tax law eliminates the rule that allows employers to deduct costs of transportation-related fringe benefits for employees, such as parking and mass transit passes. The write-off is axed regardless of whether benefits are paid directly to the employer or through a reimbursement arrangement or compensation reduction agreement. Employees can still use up to $260 a month in pre-tax money to cover parking and mass transit passes and van pools. Curiously, firms that choose to subsidize employees who ride their bikes to work can continue to take a tax deduction for their contributions. I don't know that many employees who are riding their bikes to work, especially in LA. So they're able to take a tax deduction for the contribution up to $20 per month per employee to reimburse expenses. But the tax law did not take a swipe at the cyclists themselves. They will now be taxed on their subsidy. Note that even without this perk, it is still, in most cases, cheaper to bike to work than to drive or take mass transit. And that's without factoring in the health benefits of bicycle cycling to work. However, I don't see anybody doing it. In Los Angeles, I never saw anybody riding their bike to work. I mean, I'm sure they might be in downtown Los Angeles, but if you're out having to work out in Glendale or out in the Valley or someplace like that, or if you're in Greenville, South Carolina, and having to commute to Spartanburg, no one's riding their bicycles. Never seen it. Never seen it. So now let's start talking about net operating loss deductions. The new law pares back the deduction for net operating losses. NOLs is what we call them. First, NOLs will only be able to offset 80% of taxable income in future years. Second, NOLs, carrybacks, are generally prohibited. Instead, NOLs can be carried forward indefinitely under the old law. NOLs could be carried back 2 years and carried forward 20 years. Note that the rule barring NOL carrybacks contain an oversight. The statutory language says that the general prohibition on the NOL carrybacks applies to NOLs arising in tax years ending after December 31st, 2017. While the conference committee used an effective date of NOLs arising in years beginning after December 31, 2017, the law, as currently written, allows calendar year filers, taxpayers if you want to call them, to carry back 2017 losses, but taxpayers with a fiscal year that straddles 2017-18 are prohibited from doing the same. It's very confusing, isn't it? If you're in a small business, I tell you, if you're not using a tax practitioner to file your business returns, you're probably going to get yourself in trouble because everything is so changed. And it's changing. It could be changing all the time. So I strongly suggest hire an accountant and hire a good tax practitioner. Hopefully they're both the same person. Okay? Let's talk about new family paid leave credit. Firms that provide paid family or medical leave to their workers get a new temporary credit for 2018 and 19, generally equal to 12.5% of the amount of wages paid during the time of leave. The credit is larger for employers, I should say, that pay workers over half their normal wages while on leave. Now, there are lots of rules and limitations to comply with. For example, employers must have a written policy that gives full-time workers at least 2 weeks of paid family and medical leave each year. The leave time is prorated for part-timers. And the credit doesn't apply to employees with total wages in excess of $72,000 in 2017. The IRS has published a series of facts on this issue. But I tell you, it's very, very complicated when you have to read the IRS documentation on this, because they'll say one thing, but in another sentence it sounds totally different. So we have to go through these things with a fine-tooth comb sometimes. That's what taxes are so complicated. They said they were going to simplify it, but I don't see any simplification here. So far, everything that we've talked about in this podcast, I don't see anything that's simplified. Because there's an either or if this, it's very confusing. Think about us as tax practitioners that have to think about this. Let's talk about, for small businesses and regular business, the capping business losses on individual returns. So Congress has clamped down on individual taxpayers who take large business losses in their returns. Under the new law, a couple filing a joint return is limited to $500,000 in such losses, while single filers can take no more than $250,000 in losses. The amount of trade or business loss that exceeds these caps is non-deductible, but any excess can be carried forward. Note that this limitation applies after application of the current passive activity loss rules. Do you know what those loss rules are? Of course you don't. That's why you have to hire a good tax advisor, a good tax firm that can advise you on this. Okay? One of the good things is in the real estate industry, and for those of you who are involved in real estate, is the like-kind exchange. It did survive, but only for real estate. Generally, an exchange of property is a taxable transaction, just like a sale. But the law includes an exception when investment or business property is traded for similar property. Any gain that would be triggered by the sale of such property is deferred in the case of a like-kind exchange. This break has applied to assets such as real estate and tangible personal property such as heavy equipment and artwork. Okay? So, those of you who are doing like-kind exchanges, I know we've had a few clients, tax clients, do it. It's a complicated process because there are certain timing issues and everything else. So make sure that before you do it, sit down with your tax practitioner so that you know what you can and cannot do tax-wise. Now, over the course of the last couple of years, we've heard a lot about sexual harassment. So we have to talk a little bit about settling sexual harassment claims, okay? Businesses. So the tax law has caught up with the Time's Up and Me Too movements. Okay, so businesses that settle sexual harassment claims cannot deduct the settlement amounts. They pay if the payments are subject to a non-disclosure agreement. The same goes for attorney's fees. It remains to be seen what impact this will have on employers involved on these types of lawsuits. For example, will there be fewer non-disclosure agreements or less money paid out? That's one of the biggest questions that will be asked over the next few months as we examine this new law. So, when you're doing a business, you have a choice. You can either do your business or your accounting method on an accrual method or on a cash-based method of accounting. Well, now under the new law, more businesses can use the cash method of accounting. Under the old law, C corporations with average gross receipts of $5 million or more over the previous 3 years weren't able to use the cash method of accounting. The new law raises the dollar threshold to $25 million. So many more C corporations can now qualify to use the cash method instead of having to use the accrual method. The same 25 million threshold also applies to partnerships or LLCs with C corporation owners. So I tell you, one of the biggest things is when you're in accrual, you have to keep really detailed records of what you are accruing. With a cash basis method, it's very simple. Whatever you paid, whatever you received, cash basis. Whatever you paid out, cash basis. You're not accruing specific costs over a period of time. Makes it much simpler when you do a cash basis. Way simpler, and I like it better. But so if you are a cash basis or if you're using accruals, re-examine that with your tax practitioner, because it's much better under the new tax rules to just do a cash basis and report it that way. But now, in some certain situations, when you are using an accrual for those businesses that could be an accrued basis accounting, sometimes you have to do that because you know that there's going to be various issues coming along the way, that, like on a contract basis where you can accrue it out, so you know what expenses are coming down the line, and it hits your balance sheet, and whatever hits your income statement. So you need to talk to your tax practitioner about the new tax rules of 2018 for small businesses or for businesses in general. Now, I know that as I went through all of this, you're probably saying, oh my gosh, this is a geeky tax guy talking about taxes, and I have no idea what's going on. Simplification in the congressional thought process is not simplified. They have no idea what simplified is. Nothing. They just don't get it. In some cases here, they've made it a little bit more complicated. And as you know, it starts to phase out. This is not a permanent thing. So here we get involved in doing all these taxes and planning for the future and everything, but we have to plan out only to the date that this drops out. It is very not simplified. I hope that this has helped you. Sometimes when I go through all this stuff and I'm reading it and I'm comprehending it, I'm thinking, my gosh, this is the most stupidest tax rules that we have, and it complicates the system so much more that it's absolutely ridiculous. But that's why you hire firms like myself, because it's vital that you get somebody in your corner that knows the tax rules and how it's going to affect you. Small businesses, one of the biggest things that gets them into trouble are tax issues. So contact my office if you need to. If you need to send an email to me, send it to mlodge, M-L-O-D-G-E, at lodge, L-O-D-G-E, -co.com. And I will get back with you. I always answer all emails. If I understand the emails, if I don't understand the email, I'll send back an email saying I don't get it. But send me an email and we'll try to help you out for next year. If you're wanting to start a new business, call me at my office and also send me an email and I'll help you through that process also, because we're really good at helping small businesses begin. This is Mike Lodge for the WBT. I will talk with you soon.
Thank you for listening to the WBT with Michael Lodge. Join us again tomorrow as we explore more about business and taxes. Follow us on iHeartRadio and go to our podcast website at www.wbtpod.com and listen to all of our podcasts and read our blogs.
World of Business and Taxes on WBT.
This is brought to you by Lodge & Co., a business and tax advisory firm where your success is our goal. Call us today toll-free at 888-681-1518 or visit us at www.lodge-co.com and learn more about what we can do for you. Lodge & Co., your source for sound business and tax services.